During the late 1990s, the United States experienced one of the most euphoric and ultimately devastating speculative episodes in financial history. The dot-com bubble, fueled by the explosive growth of the internet and the promise of a radically digitized future, investors began pouring unprecedented amounts of capital into internet-based startups, many of which had yet to generate revenue, let alone profits. The Nasdaq Composite Index, dominated by technology stocks, soared as a result, skyrocketing from around 1,000 points in 1995 to over 5,000 points by March 2000. This rapid surge was driven by intense market optimism, aggressive venture capital funding, and a collective belief that the internet would revolutionize every sector of the economy. At the heart of this surge was a wave of irrational exuberance, a term popularized by then Federal Reserve Chairman Alan Greenspan to describe the overheated and speculative nature of the market. Investors and analysts alike began to dismiss traditional financial metrics like earnings, revenue, and cash flow. Instead, they focused on the sheer potential and future market share of internet companies, many of which were still in the pre-revenue stage of development. As long as a company had .com in its name, it seemed destined for astronomical valuation, often regardless of whether it had a viable business model. Initial public offerings, IPOs of tech startups, became media events, with share prices sometimes doubling or tripling on the first day of trading. This fervor encouraged even more companies to go public, further inflating the bubble. However, the unsustainable nature of these valuations became increasingly apparent by early 2000. On March 10, 2000, the Nasdaq Composite Index peaked at 5,048.62 points. What followed was a swift and brutal correction. Over the next 2 years, the index plummeted nearly 77%, bottoming out at 1,139.90 points on October 4, 2002. Investors saw trillions of dollars in market value wiped out. Many high-flying startups went bankrupt almost overnight, and thousands of jobs were lost across the tech sector. Companies like Pets.com and eToys.com became symbols of the speculative excess that had gripped the market. The crash was triggered and exacerbated by several key factors. One of the major catalysts was the Federal Reserve's decision to raise interest rates in a bid to curb inflation and cool down the overheated economy. Tighter monetary policy made capital more expensive and less accessible, putting pressure on companies that relied heavily on continuous funding to survive. As liquidity dried up, confidence evaporated, and the selling began in earnest. Additionally, a slew of earnings reports revealed that many tech companies were burning through cash far faster than anticipated, undermining any justification for their sky-high valuations. The long-term impact of the dot-com crash was profound. The Nasdaq Composite Index would not return to its March 2000 peak for nearly 15 years, finally recovering in 2015. While the crash was painful, it also served to weed out unsustainable business models and helped lay the groundwork for the more disciplined and scalable tech giants that would emerge in its aftermath, such as Amazon, Google, and Apple. It also reshaped investor attitudes toward tech valuations and highlighted the critical importance of sustainable growth and sound fundamentals in financial markets.